All right, let's go ahead and get started. My name is Joe Pivarunas. I'm the founder and managing editor of Nanalyze. We're a boutique media and research firm with a large audience of global institutional and retail investors. Our goal is not to tell people what stocks to buy, it's how to make everybody a better investor. So today, whether you're long Planet, you're short Planet, you're thinking about going long or short, we're going to talk about a company called Planet Labs. Now, we've always thought you can get away with a clickbait title if the quality of content behind it is really good. And it also needs to be true as well. So when we talk about why Planet Labs stock is falling like a rock, we mean that literally. So here's a look at how the stock price has been behaving. There's a great deal of volatility involved. You can see the red line across the top there. That's the $10 a share price that the SPAC came out at. So that's where the price of shares ought to be based on what retail investors and institutional investors were willing to pay. And then you can see that today that stock price has fallen quite significantly. So what we're not going to focus on today is the bull thesis. What we're going to just touch on briefly is Planet Labs as a company. So if you're familiar with geospatial data, that's really taking satellites, and it doesn't necessarily have to be satellites, it could be planes as well, and capturing imagery among other things, and then using that to drive insights from. And there's plenty of examples of how companies can use pictures of the earth, for example, that back in the day, the hedge funds started using that to monitor the level of oil tanks so they could actually see that from space, which is really a cool way to be able to tell oil levels before they came out and trade that information, right? So Planet is a leading provider, and we won't say the leading provider. We'll talk about why or why we may how we may ascribe that title to any company in a bit here. But Planet, considers themselves the Bloomberg terminal for Earth data, and in terms of being a leader, we had this metric that we were throwing around for quite a while, and that it was Planet has 10 times as much imagery as all other competitors combined. And as you know, he who owns the data really owns the roost. So if Planet does indeed have more data than all their competitors combined, then that's something quite powerful. And we've noted a quote here. This was from Steve Jurvetson, who was his fund was an investor in Planet, and he had made this comment that he thought that Planet was the leader because they were imaging the most data. What that comes down to is Planet's constellation of satellites is taking more pictures of the Earth's surface than anybody else, so 10 times as much as anybody else combined in a single day. So when we talk about Planet having the most data, that's what we're talking about. And I think the other reason that we'd be quite bullish on Planet, aside from their data dominance or perceived data dominance, would be the frequency at which they can image. They can image the satellite up to 10 times in a single day. And this was a comment you see here taken from their one of their filings, and it said that other Earth observation companies may spend more than 10 times on a single satellite what Planet spent to build and launch their fleet of 180 satellites, whatever the number of satellites they have now. You could think about Maxar's new constellation that's coming out in somewhere in the tune of $600 million. So we're going to touch on this a little bit later, but Planet makes it a specific point to say we're able to launch satellites very cheaply. And that's a good thing too, because if the equipment becomes outdated, then it's not so costly to replace it, and you can launch more frequently and have better quality equipment in the skies. So when we look at the opportunity here, Planet is kind of scribbled this down as, upwards of $120 billion opportunity. Seems quite generous. How valuable is it to invest in a company that measures the planet from space? Well, maybe it's not a $120 billion opportunity, but there's some there. So even if it's half of that, even if it's a quarter of that, it's still a very large total addressable market. So when we look at space as an investment thesis, this is something we've always been quite interested in. And we've always been quite interested in Planet because they seem to have a leadership position. There's a lot to like about their business. They're selling their product as a service. So software as a service business is ascribe a premium. So we've always liked Planet. And when we look at the geospatial intelligence space, if you will, it's hard to say who's the leader without first defining criteria. So we want to talk about data collected every day. That might be Planet. But then if we want to talk about revenues, the company that's taking in the most revenues, that's traditionally what we'd use as a proxy for market share captured, then that would be Maxar. And we've published a piece recently on Maxar and why we don't find that company to be a very compelling investment at the moment. So when we look at going back to that chart we looked at earlier, it said, Planet stock is falling like a rock. So when we first started to notice this was when Q3 2021 earnings were released and the stock had fallen like 22%. It's quite a significant drop. So we went and thumbed through their earnings call. There wasn't anything too alarming on there, and they talked about the suspension of a large government contract. And again, this points to why we focus on customer concentration risk, and we don't like governments as major clients for companies. And then they had talked about a single satellite, one of their many satellites, having some thruster problems, and that didn't seem to be compelling enough to cause a 22% drop in the share price. So as always, we're trying to figure out why, was there something there that they said that we missed? And we took, looked through at the earnings call as much as we could. And what we did find out, and we've known this for a while now, is that there's some stock manipulation going on. And that's as easy as going to Twitter and searching for these tickers, searching for these companies that are being manipulated for whatever reason. You can think of meme stocks. So the stock market has always had manipulation going on. It just bears different names at different times. And the meme stock types, there's a lot of manipulation happening there. So if you go search on Twitter for the names of companies like Rocket Lab or IonQ, or better yet, here's what you do. Go say anything negative about these companies and watch the backlash. And that tells you right away. And these people are zealots. They're I think the reason that they're so persistent is they probably put all their eggs in one basket with these stocks, and they really need that to be right versus going out and making some real money and then putting it into a diversified portfolio and growing it. So these are the get rich quick types. It's laziness, and it's also intellectual laziness, because if you really put all your eggs in one basket, you probably want to know the merits of the company that you're investing in. So you'll see these people on Twitter, you'll see them come around in the comment section of this video, and they'll have a rocket in their Twitter profile, or they'll have a little atom, and that shows their allegiance to the cult stock that they're following. And then if you dare criticize their sacred cow, they'll just inundate you with just absolute drivel. So they don't actually have anything of quality to add to the conversation, so they'll just start attacking the messenger. Now, this is a good time to mention that we're actually long the stock. So we've taken a very small position in Planet Labs. In terms of whether we're growing that position, buying or selling, that's something that our premium subscribers will be told about. So we do have a small position in Planet Labs, and incredibly, you can have a position in a stock and also be very critical of it. And that's what we're going to do today. So when we look at Planet Labs, how it trades today, we use what's called a simple valuation ratio that takes market cap, divides it by annualized revenues. And we say annualized, we mean take last quarter, multiply it by 4, and then you get a number. And the number for Planet right now is 11.6. That's quite low. So we wouldn't say at all that Planet Labs was significantly overvalued. Is it fairly valued? That's hard to say. How long is a piece of string? But we would consider shares right now, based on our universe of tech stocks that we look at, to not be significantly overvalued, certainly against other space companies as well. So when we want to dig a little bit deeper into the company, one of the reasons that we're, let's say, hesitant about adding to our position, to be honest, is that we don't have a lot of information. Now that's increasing. So when earnings first came out, there wasn't a 10Q. We emailed the company. They emailed us back and said, listen, we're going to put out a 10K. Keep an eye out for that. And then when we went into the SEC filings just a couple days ago for this presentation, there was some new stuff there as well. So some of our questions did get answered around customer concentration risk. Now, these are some key metrics that were made available in whatever filing this was pulled from. And the top metric is really important to pay attention to. So net dollar retention rate looks at all the customers that you have. If you're a software as a service business at a single point in time, that's called your run rate. That's the amount of money you can expect to get. Now, the amount of money you can expect to get from existing customers, if that's 100%, that means you're not increasing prices, nobody's canceling, you're just going at the same rate. So when we look at existing customers and net dollar retention rate, we're looking at how can you get your existing customers to spend more money with you. That's a lot easier than going out and getting a new customer. And we could see that number if it's, as I said, 100%. They're not increasing, but you could see where it was 132% in 2020. That's really good. New customers are paying a lot more money. But when it falls under 100%, that's very concerning. And that's what's happened here. So they've attributed that drop, the number here, they said it was due to a renewal value of a large government contract. Again, going back to that earlier point, and it appears to be Afghanistan. So that's very important to look at customer concentration risk, and we're going to look at that in a second. And there's some other metrics here that are interesting. I wanted to point out, the growth in customers, of course, that's only useful if you start to describe how much customers are paying in different cohorts. So how many customers are paying more than 100,000? How many customers are paying more than a million? Many SaaS companies will spell that out. Percent recurring, that's very useful. That's great. We want to see almost all recurring revenues. And this last point here is an interesting one. It's the capital expenditures as a percentage of revenue. So they're really pushing the competitive advantage of being able to launch satellites cheaply. So the amount of investment or capital they need to keep their business going, they've equated that to being similar to hosting fees. And we're going to talk about those. They've said, listen, we're a software company and this is just a cost of doing business. Whereas other companies that launch satellites, they spend tons of capital and they're more satellite companies with a software component. So they're saying the capital expenditures that we have compared to others are quite low, and that's a good thing, right? When we look at customer concentration risk, so these are some interesting numbers here. We don't have that 10K yet, but we do have a recent filing that says in 2021 they had 2 customers accounting for 13 and 10% of revenue. So we never want to see any customer accounting for more than, let's say, 5% of revenues in a SaaS business, or less. Lower the better, right? But 10% is certainly high. 2 customers, almost a 25% of revenue. That's a pretty big risk there, and we don't know what that is. What will happen with new businesses is that will decrease over time. So you may have some reference customers that are doing a lot of business, and then as you use those to get more customers over time, then the number starts getting smaller. And we're seeing that, but we don't know what that number is for 2022, and we need to wait for the 10K to see that. So that's something we're looking forward to seeing. And then this is really interesting here. We pulled this chart. This shows between 2020 and 2021, the first 9 months. And there's some interesting things going on here. So they're taking the geographical breakdown of revenues. So, for example, some Norwegian company came on board. Given Planet's focus on ESG and all that, that's probably understandable. So they have a big Norwegian client that's just come on board, or let's hope a handful of clients. Canadians have fallen off a cliff. The rest of the world has increased. The United States has decreased. How does that work? So these are large customers that aren't using the product 1 year and using it the next. Planet has at least 2-year contracts. So we're having some difficulty trying to understand the breakdown of geographical revenues and how that changes based on what's actually happening with their customers or what they're saying is happening with their customers and whatnot. So these are things that we don't have insights into, and we'd certainly like to have some insights into. Now, when we look at the customers that are accounting for revenue, one of those we believe is Google, and we want to talk a little bit about Google. So we've used the term here BSD, and I don't know how many of you are familiar with what that is. And I think I'll give you a story, a short story to tell you what that's about. So back in the day when I was doing my MBA, you had to pound the ground if you wanted to get into investment banking. It was extremely difficult, right? Extremely competitive. So we used to go down to Canary Wharf and down to the city in London and meet with people on the weekends. And every weekend, some of us would be down there trying to shake hands and trying to meet as many people as we could, desperately trying to get an internship. That's what you're trying to get. Then you can show them that you're a BSD and then get a job. Now, BSD stands for Big Swinging Dick. So I'll give you this example. I was down in Canary Wharf with a number of individuals from our class, and there was a lady in the mix, and we met with the prop trader. Now, back in the day, prop traders at Morgan Stanley they were big swinging dicks. They're bringing in a lot of money, and they could get away with whatever they wanted. And that's just how it was back in the day at investment banks. And you had to be bringing in the money. You had to be, show me the money, right? Well, we met with this guy, and she had asked him. We were all going around the room asking questions. She asked him, as a female, what are the chances that I can get a job in investment banking? And he leans forward, looks at her, he goes, here's how that works. We're going to walk you down the trading room floor, and if you turn half the heads, we'll hire you. Now, whether you find that comment hilarious or offensive, it's not the point. The point is that's a big swinging dick attitude. That guy does whatever the fuck he wants. And This was a term coined in Liar's Poker, that excellent book that talks about investment banking environments and how these sorts of often psychopathic individuals will dominate firms because they're generating a lot of revenue. So when we look at Planet Labs and Google, Google's the big swinging dick. When Google sits at the negotiating table, they decide what happens. And people out are talking about Google being an investor in Planet Labs as that being a good thing. And maybe that is, but you need to consider the sort of the sort of people that you're getting in bed with. So Planet Labs and Google have a relationship that goes back to when Planet Labs bought Skybox Imaging from Google. Now, Google had acquired an Earth observation firm called Skybox Imaging. They changed it to Terabella, the name, and then they sold it to Planet Labs. This was back in 2017 after acquiring it in 2014. And then Planet Labs at that time had sold equity to Google, or say Google held equity and still does. They hold about 13% of Planet Labs. Now, when you go into digging into the filings, you start to see some interesting stuff. So Google's actually, they're a 13% owner, but they're also a customer. So in 2021, $11.5 million came from Google. So we believe that's the 10%. They're one of the largest customers. That data contract is up for renewal in April of this year. So that's something to keep an eye on. What if Google decides they don't want to spend any more money with Planet Labs? Well, that's going to be a big deal, right? The other thing that you need to consider here is just how much money Planet Labs is giving Google for cloud computing costs. And they list this as a liability that $196 million over the next, I don't know, 5-6 years that they're going to be paying Google for cloud computing costs. So those of you out there that want to talk about how great it is that Google's, or say Planet Labs in bed with Google, it's not necessarily the best thing. So you need to keep that in mind. And then we're going to go from talking about BSDs to PBCs. So this is a red flag for us. And what this is, it's a public benefit corporation. So Planet Labs has decided to be a public benefit corporation. And other firms they're joining in that same realm are Ben & Jerry's, Patagonia, and Zymergen. And anybody who knows anything about those first two brands will know that these brands are very political. Ben & Jerry's always has been. Patagonia is very, very political, going so far as to clearly show their allegiance to only half of the potential customer base by picking a political side. And that's what you have to be very careful about in business, is not doing that, because if you're in a very politically charged society and you decide to take a side, you've cut off, especially when it's more or less right down the middle as it is in the States, you've cut off half your potential customer base. So we don't agree with companies that do that. Now, the idea of a PBC is that you're benefiting the planet and all that stuff. Well, we don't believe that company CEOs should be focused on anything except generating shareholder value. You generate the value, we'll get a return on our capital. We'll go find the charities that we want to contribute to, and we'll contribute to them. So we think that a public benefit corporation is a distraction. And what does it mean? It doesn't mean very much. It's just a different type of corporation, and then they have to put out a twice a year report on how they're benefiting society. And the reason that a firm might do this is to attract the ESG types. So there's a lot of money going into responsible investing. And that appears to be what Planet Labs is trying to do. So let's just hope they keep the focus on adding shareholder value, and they don't allow that to be a distraction. So going forward, what we're waiting for is the 10K, and what that'll give us is the final 2021 revenues, which are really looking good. We'll talk about that in a second. The customer concentration risk, we'd like to see that updated for 2022. Again, fiscal, this is really annoying when companies do this, the fiscal bit, right? So they're in 2022, but we just got into it. It's really annoying and confusing. But at any rate, you understand what we mean. So we want to understand that customer concentration risk, how that's changing, hopefully decreasing, and then see if there's any other information that we can glean from that. So that's kind of where we're at in a holding position when it comes to stock. Now, I wanted to touch on revenues. This is really impressive. Now, when we look at, and I say impressive, it's because the bar is set so freaking low, right? So when we look at SPACs, every SPAC out there has forecasted their revenues, just whatever. They just pull it out of their ass and say, this is where the revenues are going to be. And it's just ridiculous numbers. And they actually try to show how they're able to produce better predictions of the future than others. It's like my predictions are bigger than your predictions. It's absolute rubbish. It means nothing. These forward-looking statements. Now, you in the bottom lower left here, that section there, you can see the 44% compound annual growth rate for revenues that Planet Labs had predicted. You could see that for 2022. This was in their SPAC deck. They forecasted $130 million. They just reiterated that, and they finished with third quarter 2022, and now they've got fourth quarter 2022. You can see that in the upper left there. It looks like it's going to be a record quarter, and they're reiterating. Now, the worst thing you can ever do is reiterate and then come out fourth quarter and say, "Oops, the Rona," right? So how many times are people going to use that excuse? But let's hope that this is on track. Let's assume it's on track. That's great, and we're going to hold every SPAC to what they said. So all the SPACs just started saying all these great revenue numbers. Well, guess what? We're going to hold you to what you said, and they did what they said. That's great. That's what we're expecting. So that, again, as I said, the bar is pretty low, but they did what they said. That's great. So we're really happy to see that. Now, there's probably some other information that would be useful, kind of sector breakdowns. There's a lot of ways that we'd like to see their revenue described, but hopefully when the 10K comes out and they hit that number and everything, then they'll go ahead and hit their next number, which is pretty big. So what, fiscal year 2023, 191 million. They've recently made an acquisition. We don't know how much that's going to increase revenues, but the company's on the right track when it comes to generating revenues. Now, what we're trying to do when we look at any thesis, we're trying to figure out who the leader is and invest in them. So you could start to maybe argue Maxar versus Planet. We like to look at who a company says their competitor is, and these are some names taken from Planet Labs filing, and we've covered some of these names. We may do some presentations on some of these companies. One that's not here is Spire. That's because Spire does something differently. They also observe the Earth, but in a different way, and we've always considered them to kind of just be part of that domain, though others disagree with that classification. That's fair enough. On the bottom here, you see they mentioned some other names: Orbital Insights, Descartes Labs, Geospatial Insight. These are firms that take the imagery and then do analytics or use AI algorithms, apply them, and then derive insights. So they also consider firms like that to be competitors. Now, we will look at doing some future presentations on some of these companies, but we didn't want to get into that today about who's better and all that. We just wanted to stick with looking at Planet Labs. So just to conclude, a couple things here. SPACs are risky. We've covered over 75 SPACs. They're in our tech stock catalog that lets us pull up pricing real quick and see how they're all performing. We've always said SPACs are risky. Planet Labs is the only SPAC that we have some chips on at the moment, a very small handful of chips. And that's because we believe SPACs are exceptionally risky. And if they're risky, then space SPACs are phenomenally risky. So we really just proceed with an extreme amount of caution. And anybody who's invested in some of these space stocks right now, like Spire, was looking Spire somewhere under $3 a share now, $2.50 a share. Not that we really care about short-term price movements, but that's interesting. So we'll probably take a look at why that company's trading the way that it is. Probably has something to do with maybe not meeting the revenue growth forecasts. Volatility, going back to the comment about stock price manipulation, you can just expect it, and you better get used to it, and you better be able to sleep well at night, even though you have you're holding a very volatile stock. And then Planet is also a very small company, and we've broken down recently, looking at size, how we rate companies by size. And as risk-averse investors, we always want to be holding larger companies. Planet is very small company, so that's something we're trying to avoid. So we're going to go ahead and wrap that up. If you go to Nanalyze, you can check out all our research, which surrounds a lot of different disruptive technologies. If you look in the description of this video, we're going to put links to articles we've written about Planet Labs before that go really and delve into that bull thesis. And go ahead and subscribe to our YouTube channel. Companies we're going to be covering next, probably AST Space Mobile, Spire, some other names. So look forward to that. Thank you so much for your time, and make sure to join us in the future for other videos. Thanks.